Welcome to this explainer. If you're gunning for that top-tier A-star in IGCSE Accounting 0452, you are exactly where you need to be. Today, we're jumping straight into a high-energy, deep-dive mentoring session on one of the most notoriously dense modules in the entire syllabus, accrued and prepaid expenses. I'm going to be your guide as we completely demystify this topic. We aren't just here to memorize rules, we're going to build your financial intuition from the ground up, blending advanced technical methodologies with direct warnings from senior examiners. By the time we wrap up, you'll be dissecting complex exam scenarios with absolute confidence.
All right, let's quickly run through our roadmap for today. We'll be looking at core architecture and concepts, securing your method marks, AO3 interpretation and ratios, the quality of profit, and finally, those winning exam strategies.
Okay, let's kick things off with Section 1, Core Architecture and Concepts, Building the Foundation.
You know, while modern AI-driven fintech apps like Xero are great at automating simple data entry, they absolutely cannot replace the human insight you need to manually adjust for accruals and prepayments. This module right here, it's your bridge to true financial intelligence. And the whole thing rests on the absolute bedrock of accounting. Assets always equal liabilities plus equity. It's the non-negotiable rule. You've got to maintain this exact equation at all times during the fiscal period. Every single transaction has a duality. So when you adjust for an accrued expense, you're not just tweaking a single number. You're increasing an expense which impacts owner's equity, and at the very same time, you're creating a current liability. Honestly, if you lose sight of this equation in the exam, the entire structure just collapses.
So there's this constant tug of war between two massive accounting principles here. On one side, we have the historical cost principle, which anchors us to original transaction values. But on the other side, the prudence concept. Students lose marks all the time because they overstate profits by simply ignoring potential losses. And guys, that is a direct violation of the prudence principle. Think about it like this. If you know you owe an accrued expense, but you haven't actually been billed yet, ignoring it artificially inflates your profit. That is a massive red flag for stakeholders, like banks and tax authorities who completely rely on the absolute transparency of your financial reporting.
Now, staying current is absolutely crucial. Cambridge has shifted to modern international terminology for the 2026 syllabus, and looking ahead to the 2028 and 2030 updates, this exactness is going to be heavily scrutinized. You literally cannot use the outdated terms anymore. It is strictly irrecoverable debts and owner's equity. If you're targeting that A-star, you need to use these exact terms with 100% accuracy. Examiners are actively looking for this modern vocabulary. It's an immediate flashing indicator that you are a well-prepared, top-tier candidate.
Moving right along to Section 2, Securing Your Method Marks, Flawless Technical Execution.
Let's talk workflow. The exact procedural chain starts with Step 1, identifying the correct source document, like an invoice or a credit note. This feeds straight into Step 2, your books of prime entry. Then we hit Step 3, which is really the engine room, the T-account posting. This is where you absolutely must master balancing and correctly distinguishing between a balance brought down and a balance carried down. Finally, Step 4 pushes all that flawless data directly into the trial balance. Make a mistake anywhere in this logical flow, and you're looking at cascading errors down the line.
But as we know, the path is full of traps. Some of the most common mathematical pitfalls that trip up literally thousands of students every single year include things like miscalculating a trade discount versus a cash discount. That will completely destroy your entry. Or forgetting state symbols in your manufacturing accounts. It just shows a lack of technical polish. And of course, getting your brought down and carried down balances flipped. Actually, scratch that. It's not just a minor slip. Flipping those will instantly confuse the examiner reviewing your ledger.
Okay, take a deep breath, because I'm going to share a senior examiner secret that should instantly lower your exam anxiety. Method marks are awarded even if the final balance is incorrect, provided the logical flow is visible. So, if you make a tiny mathematical slip under pressure, all is not lost. But, and this is a huge but, you have to show your workings clearly. Please do not hide your math. If the examiner can see your logical methodology and exactly how you applied the double entry rules, they will reward you with those critical method marks.
All right, on to Section 3, AO3, Interpretation and Ratios, the Cause and Effect Chain.
Picture this, you're sitting in the exam hall, tackling the investigative, practical side of accounting. You've crunched the numbers, and you calculate that a business's current ratio has plummeted from a super healthy 2.5 to 1 all the way down to a really alarming 1.1 to 1. Now, for your average student, the job is done. They wrote the number down, but not for you. An A student doesn't just calculate a ratio and move on. They ask the underlying why. Why did it fall so drastically? What is the actual cause and effect chain going on here? This is exactly where you elevate your answer from a simple, basic mathematical output to a senior-level business evaluation, really proving those high-level AO3 analytical skills.
So, what are examiners desperately looking for when evaluating a liquidity crisis? To recall these specific causes under immense exam pressure, I want you to use a really quick memory hack, ICE. I for inventory that's been heavily overpurchased, tying up your liquidity. C for cash reserves being totally depleted by a sudden capital expenditure. And E for expenses and trade payables being settled way too slowly, leading to mounting short-term debt. Nailing these cause and effect chains is the exact blueprint for securing maximum AO3 marks.
Next up is Section 4, the quality of profit, beyond the surface numbers.
Two completely identical businesses could show entirely different profit figures just because they apply different internal accounting policies. For example, one might use straight-line depreciation to spread the cost evenly, while the competitor uses the reducing balance method to front-load the expense. Because of variations like this, you really have to look deeper. You need to assess the true quality of their profit and understand that the bottom line on an income statement is massively influenced by internal policy choices, not just operational success.
And beyond the math, there are invisible forces at play here. Vital, non-financial factors, like staff morale, physical location, and market reputation, are never going to appear in a T account. Yet they absolutely dictate a business's long-term sustainability and ultimately its return on capital employed, or ROCE. When you're drafting those evaluation paragraphs, synthesizing these non-financial factors right alongside your ratio analysis is the absolute hallmark of an exceptional candidate.
Finally, we arrive at Section 5, Winning Exam Strategies, the Examiner's Playbook.
Pulling directly from the principal examiner reports, you absolutely need to follow these rules. First off, do maintain perfectly clear, legible handwriting in all your ledger accounts. Think about it. If they can't read your numbers, they can't give you the method marks. Do manage your time based on the specific weightage of each question part. On the flip side, don't confuse revenue items with capital items. That's a fatal conceptual flaw. And above all else, don't hide your workings or skip procedural steps. Seriously, A-star candidates needlessly bleed marks here every single year. Don't let that be you.
Well, we've reached the end of this explainer, but I want to leave you with one final A challenge. Pause and really think about this scenario. If your exam throws you a curveball that mixes a simple accrued utility bill with a massive capital equipment upgrade, can you flawlessly document the evidence in the ledgers without violating the prudence concept? Mastering that exact multi-layered intersection of theory and practice, that is what's going to elevate you to the top tier of IGCSE accounting. Thanks for hanging out with me for this deep dive. Keep those workings clear, and I'll catch you in the next explainer.